So I'm going to speak briefly about safe havens. This is an area where we make our hay at Universa, specifically in a very small subset of safe havens. And I've been in this area for about 20 years, so it's near and dear to me. We all understand safe haven investments to be places of refuge when the hits the fan. But let's not think of them as a place or a thing, but rather as a particular payoff. They're reliable, and the key word here really is reliable payoff that lowers the systemic risk in a portfolio. They specifically hedge the left systemic tail, if you will, of a portfolio. And if they don't do that, then they're something else, like maybe a diversifier or whatever, but they aren't safe havens. Now, this topic may seem a bit anachronistic today, so please humor a very brief obligatory Cassandra speech here. Today's historic central bank manipulation of markets will eventually have to end one way or another. They will fight it by hook or by crook, but that end will inevitably happen. And when it inevitably happens, it's going to include a similarly historic market crash across many assets. And the longer we wait, the worse it will be. So there, I'm done with that. Anyway, maybe asking a guy like me if the market's going to crash might be a little like asking a barber if you need a haircut. But this market's come a long way without a haircut. So you needn't agree with me on this to follow along. But if you bet on this with a safe haven, you better bet right, because you could easily be right and still have bet wrong. Betting your beliefs here is going to be very tricky. Why? Because markets crash after they've been distorted in one way. It's just that causal. You need the cause before the effect. The bigger the cause, the bigger the effect, the harder to time, and the messier the effect. Financial systems and markets are non-ergodic. They do things always a little bit differently, specifically to trap the timers, the data miners, the naive hedgers. But fortunately, with the right safe haven, none of this stuff, forecasting, really matters all that much. Now, here's how I see the spectrum of safe havens. Boiled down to just two basic types: a store value safe haven and insurance safe haven. We're looking at three things here. One, how does it do in a crash? Two, how does it do in a non-crash? Three, how much confidence do we have in those two expectations? How lucky do we need to be for this to work? They need to at least hold their value in a crash. They need high confidence, low noise, and the insurance haven specifically needs an explosive profit in a crash relative to its small losses the rest of the time. So it needs to be highly convex to crashes. Some safe haven dynamics require an extrinsic value pickup, so a flight to quality sort of momentum effect, making them noisier, and those relying on intrinsic, less noisy. This noise tends to show up in the volatility of the payoffs, so we need to understand this. So let's see what these two safe haven types do for a portfolio, if anything. The best way to look at this is through a little cartoon thought experiment heuristic. Here we have two fictional cartoon safe havens: a store value safe haven on the left, providing a 2% real annual return, and I'm being extremely generous here, I know, and an insurance haven on the right, providing 0% expected return over time, and I've fixed this ex post for whatever time period we're looking at. So we know that it has that expected return. And so here we have their simple dynamics bucketed by different corresponding annual returns in the S&P 500, and throughout I'll be bucketing this way as a proxy for systemic risk. So think of these as contractual payoffs, no noise, no counterparty risk. So by the way, any preferences between these two? Most would say left. So let's see how these cartoon safe havens would have helped a portfolio of equities, the SPX. Here are the package's historical performances, bucketed again by the past S&P returns, going back in this case to 1901. The blue bars are the average annual portfolio returns for each corresponding bucket. Next to the SPX alone in gray, the vertical line plots are the range of annual returns within each of those buckets. So with a 10% allocated to the very generous store value safe haven on the left, there's some, but not much, pickup during a crash. And the package actually underperforms, as you can see, in the long run. The one way to make this work for you is to go really big in that safe haven, soon before a sell-off. Of course, with the risk of big underperformance if your timing is off. So this is very tough. The bar is very high for the store of value safe havens. Now with the insurance safe haven on the right, with only 3% allocated, you are indifferent to when the crash actually happens. It adds to your compound return over time. This is very counterintuitive and weird. How can adding something with a 0 expected return to a stock portfolio add to that portfolio's compound return? Remember, the arithmetic return of two things is the weighted average of those two arithmetic returns. And we're only investing 3% of our portfolio in it, and yet somehow this is raising the long-run compound return of this portfolio by some 50 basis points. And that's the same contribution, by the way, the 3% allocation to an uncorrelated 20+% returning investment would have given you. Okay, you need to go back one, please. Go back one. We can go back to 19. Anyway, same thing starting 20 years ago. If we can go back, same thing going on. Of course, the insurance, what really is the key here is that since 96. Okay. The key here is that the insurance-like payoff lessens the portfolio drawdowns, the destruction that those have on compound returns. It's really a bit of a math geek puzzle, but the implication is huge if you think about it for allocation to safe havens. The tiny required safe haven investment also allows more to be invested away from the safe haven. This is also what takes that timing luck entirely out of it. It's still an optimal trade if you happen to have some edge in precisely timing when that next crash is coming. But that's really just not important. And this is really hard to grasp for most investors. It's very Clausewitzian, very, very roundabout. Now, there are also many what I call safe haven imposters. You can move that ahead for me one. Safe haven imposters. These are assets that are presumed to be safe havens, but actually they aren't at all. We have the unsafe havens and the hopeful havens. The first are often as vulnerable in a crash as that which they're trying to protect. And the second are just too unreliable, too noisy, requiring a lot of luck for that safe haven to work. And when you require a lot of luck for the safe haven to work, to do its basic job of controlling risk, this actually means more risk, not less. It's kind of like jumping out of an airplane with a parachute that only sometimes deploys. You're better off not wearing one in the first place and making a more informed risk management decision. Okay, so now that we know what to look for, we're ready to take a quick peek at some safe haven histories and classify these guys. Now, we're just being naive empiricists here. Markets are non-ergodic. The future will not look like the past. But if they were imposters in the past, let's at least not be fooled again. And you'll see that at 10% of a portfolio, many safe haven imposters may incrementally move the risk profile, but really can't do much without putting way more in, almost replacing the portfolio. Okay, so here we go. Hedge funds. There's a lot of beta. Clearly, these are unsafe havens. Looks like it adds a little alpha. I suspect that survivorship bias overcomes that, but it's an unsafe haven. A long-short equity, exactly the same story. High dividends, clearly an unsafe haven. Lots of noise in there as well. Rates, even more noise. Risk parity, unsafe haven, at best a hopeful haven. Hardly moving our risk profile as we had 10% to it, and even if we go all in, it's not something that's really providing you a lot of risk. There's a lot of noise down there. This is probably surprising to most people. Dollar, again, unsafe haven. Maybe it's a hopeful haven. The more noise you have, the more we're going to say we're relying on luck for it. Art, who knew Picasso isn't going to protect your left tail? CRB, again, noisy. Again, these are thought of as safe havens. They're not really moving the needle for us. Value, here we have a hopeful haven. It looks like a store of value. Perhaps it's a store of value. But again, particularly on when the markets are up in that rightmost bucket, we've got a lot of noise. But now we're moving into probably something that's a real safe haven. Again, a hopeful haven, even more noise in the yen. And this would apply even less as a haven today. I didn't hit that one off. Midwest farmlands, yeah, store of value, very noisy. Guys got to eat. 10-year bonds, a pretty good store of value. They haven't really, surprisingly, they haven't really done much from a performance standpoint. as we would have guessed, being a store of value. You got to get your timing right to make movements in and out from bonds to equities makes sense for you. Very much a timing trade. But a fairly good store of value. However, I should add that today, with rates as low as they are, you're going to have very different performance. There's not a lot of room for rates to go down, certainly. Ditto with the 3-month Treasury bills. But a decent store of value. More problematic today, certainly. CTAs, again, we're moving into a much better store of value. I suspect there's a bit of survivorship bias in here as well. So now we're moving into the insurance safe havens more. VIX has been pretty good. It's not tremendously convex, but it's pretty good. But however, clearly we have some extreme noise, particularly when the markets are up. You get severely punished. It almost, in many ways, could be a linear trade for some people. And of course, this is the spot VIX. So this isn't even tradable. If I was going to look at the futures, it would look far, far worse. It's a stinker of a trade because of the roll down. So you'd want to stay away from VIX futures and even VIX spot. It's a hopeful haven. CDS, we're getting a little more convex here. It's doing more for your portfolio, certainly. I'm going to say they've got a little bit of hopeful haven in there because of the single counterparty risk involved in this. It'd be nice to be able to aggregate that. But we're getting some convexity, so it's looking more like insurance. Ditto high yield, even more convexity there. Same counterparty risk. The Swiss franc, a decent store of value. This used to basically be gold. Of course, now thanks to S&B, maybe it's going to react more like Apple stock. And so even more, we should expect even more noise going forward than we got in the past. Silver's crazy. Gold, again, it's insurance. It doesn't have the convexity that I think most people would expect it to have, and of course, it's been very noisy. I happen to think that going forward, it's going to be a pretty good insurance safe haven. But we should think about what it's done in the past and making our expectations for what it's going to do for us in the future. So next we have the tail hedge. So this is what real insurance looks like. The equity tail hedge is the most extreme case, really. And full disclosure, this is what we do at Universa. It's a very, very simplified, generic equity tail hedge example. Short-term, way out of the money puts. We don't have time for the details, but it isn't meant to represent any one specific return anyways. But here we have the same general dynamics going on as that cartoon heuristic safe haven, insurance safe haven that we looked at earlier, allocating 3%. And this here parachute is the most likely to deploy. We're staying away from single entity counterparty risk, of course. So let me just move this one more. So anyway, I hope I've at least given you a framework to think about safe haven investing. Maybe this tempered our expectations a bit. Paradoxically, what makes a safe haven the best is actually how much of it you don't need in order to stay safe. It's convexity. This removes luck, timing, the complexity from the decision-making process, and lowers risk, raises compound returns. So I'll leave you with this. The best safe havens don't keep ships away from risk, but rather allow them to take more and better risks and actually stay out of the harbor. Thank you.